Montana's recognized for 5
Well,
minutes.
I want to thank the chair and ranking member. I also want to thank you for being here, Mr. Chairman. I appreciate it. I've just got to say one thing about Senator Kennedy. I think freezing spending is probably a really good idea, except we just had a flood that cost $1 billion worth of damage in southern Montana. $1 billion worth projected. We freeze spending, that infrastructure never gets rebuilt. So I hear what you're saying, and in some aspects I agree, but it's a lot easier to talk about than it is to do. And I think that's the challenge that the chairman of the Fed has, is that he really needs to focus on what he needs to do. And if it was a simple solution, we'd already had it done. I'm concerned about rural America and the impact inflation's having on rural America. And I know that you have seen it. You've seen it transpire over the last several years, particularly as this country's come out of this pandemic. And I know we've had a conversation that it's two-edged, it's supply and it's demand, and you're only dealing with the demand part, which is an important part. And in some respects, Senator Kennedy's right. You are probably one of the strongest people in the world to be able to deal with some of this stuff. But from a rural perspective, is the Fed doing anything in particular that I could take back to my constituents and say, this is what the Fed's doing to help rein in inflation in rural areas?
Well, so we are, of course, well aware. As you know, we have 4 or 5 Reserve Bank presidents who have very large agricultural economies within their districts, and we hear excellent reports from them about what's going on. And it's clearly a tremendously challenging situation. Fertilizer prices and all kinds of inputs, very, very difficult situation. Can't get parts for your equipment and that kind of thing. So, overall, we do appreciate that. You're not seeing this yet, but when if times do get difficult, then we work carefully with borrowers in the Farm Belt and that kind of thing, because we know, that's what you do in those kind of times. We're not at that times at this point, but that's one thing we have done in the past. I mean, overall, we think we need to get back to price stability, and that will help. That will help everybody. It will help the whole economy, including rural America.
Okay, interest rates. I know they've been raised a bit recently. I think 3/4 of a point. Correct me if I'm wrong. And I'm not going to ask you where interest rates need to be, but I do think that there's a fine line to walk, and you tell me if I'm wrong, where if interest rates are raised too high, it could drive us into a recession. Can you tell me some of the things you're looking at to make sure that doesn't happen?
Sure. So when we pivoted and started talking about raising rates last year, markets have priced in rate increases so that all out of the curve of debt maturities, interest rates have already moved up to reflect interest rate increases that we haven't actually made yet to our. So what we have right now is a low short-term rate, which is our policy rate. So, and the increase that we made one decision at the last meeting, which was to raise by 75 basis points, but only to 1.6%. So, and we thought that was the right thing to do. I'm happy to discuss why, but really the point is that our policy rate is still at a relatively low level, and in principle, we want to get it up to a more neutral-ish level. Even more expeditiously than we had been, and that's what was behind our thinking. And that's really, so the concern, I don't think is about the level, it was with the speed. Are we moving too quickly? And I think I was persuaded that it was important that we make this move now and not wait and telegraph it and do it 6 weeks later, for example, or the meeting after that. It was important to do it now because where we are with inflation is having seen inflation come in above target over and over again, and we said we'd move more aggressively if it was appropriate. We thought it was appropriate, and we did.
So what? And so you said you want to get to things more to a neutral level, and are we to a neutral level now?
No. So we estimate the longer run neutral level of the federal funds rate to be in around 2.5%, and actually we think it will be appropriate to raise rates above a neutral level into a modestly restrictive level, because this is very high inflation and it's hurting everybody, and we need to do our job and get inflation back on a path down to 2%. And the way we're going to do that, we think, is raise rates, of course, to that level. Of course, everything depends on the data that we see. We're going to be we're really strongly committed to getting inflation down to 2%, but we're going to be flexible as we see the data coming in.
Do you agree with the perspective, and then I'll be done, but do you agree with the perspective that if interest rates go too high, too fast, it could drive us into a recession?
It's certainly a possibility. It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
Yeah. Thank you. Thank you, Mr. Chairman.
Senator Chester. Senator Hagerty of Senator